Fibonacci arcs provide a certain degree of detail for segments of a trend. They help get a better idea of particular ranges in price and time that can become important. To a lesser extent, trend projection and time analysis can be done in select cases. Since Fibonacci arcs can be highly context-dependent and less intuitive compared to other Fibonacci tools, this tutorial will be focused on examining a wide range of real chart examples from various time ranges. Along the way, we'll see various uses of Fibonacci arcs, preferred conditions for their application, and cases where they fail and/or have limitations. So no matter when you watch this or which charts you choose to apply Fibonacci arcs on, information from this tutorial can be of use to you. Because there's a curvature with fib arcs, it's necessary to lock scales on the chart to prevent distortions when zooming in and out. It's the exact same thing we discussed with fib spiral settings. For further detail on this topic, you can refer to the section on important settings in the fib spiral lesson. Other than that, you can change the appearance of the arcs based on personal preference. Leaving all these default values checked will be fine. These are all those familiar fib levels we've seen before, but now they'll be in the form of arcs. The first point is the origin point starting from the center of the arcs. The second point's placement will determine the size of the arc. Similar to other fib tools, there's the option to display a trend line to connect these 2 points in order to better visualize their connection to each other, because their placements and the distance between them will have an impact on their resulting arcs. And since fib arcs are half circles, the entire horizontal length is the diameter of a circle, which can also be thought of as twice the radius. This even spacing can relate to cyclical lines and time cycles, along with other even intervals, such as sine lines and certain fib techniques where repeating intervals are used. This example begins with a steep uptrend that's starting to end, and transition towards a distinct downtrend. Once another downswing is unable to surpass the previous high, it's time to consider a fib arc. In this case, the arc starts at the highest point of the uptrend. The second point extends back down to the lowest point of where the uptrend began. A highly preferred feature is to see price follow the curvature of the arcs, particularly the first one formed by the 0.236 level, which in this case is of course an arc instead of a horizontal line like on a fib retracement. On the way down to the arc formed by the 1 level, retracements have a tendency to approximate the curvature of the arcs. When price nears the arc formed by the 1 level where it has recently contacted, a more significant event is likely to occur. And that's usually more opposition to the trend, such as in this case where the stable downtrend has begun to move more neutral to bullish, and this began after contact was made with the arc formed by the 1 level. Major events such as this bullish breakout are also more likely to occur near their subsequent arcs. Basing an arc from the peak down to the first upswing point naturally produces a smaller arc, which can be helpful for short-term details, especially near the end of the downtrend. Here there's still the preferred characteristic of price following the curvature of the arcs, but this might not always be possible to see, especially with very small fib arcs. In such cases, it could also be sufficient to see the reversal candles being encompassed mostly within the first arc. Fortunately, in this case, we see some major movements follow the arcs quite well, along with areas where there's flatter movement and congestion of price near contact with the arcs. Here's a good example of some of those characteristics, except with an uptrend now. Similar to the arc formed by the 1 level, more significant events can also tend to take place nearing the final arc, formed by the 4.618 level. Here, it's a similar situation with contact and the move towards more neutral to bearish price movement. When there is a major trend reversal, but a lack of clear swing points, it's still usually possible to place the points of fib arcs around the lowest and highest points of these reversal areas, which can still provide satisfactory results with price following the curvature of arcs, or beginning to find congestion and resistance upon contact with the arcs. It's also possible to base fib arcs on the final swing points of a trend, in this case the last upswing of an uptrend, and when there's a major long-term continuation. Such as this ongoing downtrend, it's best to use more recent swing points in the context of the larger trend. In this case, it's the downswing that began this smaller downtrend that led up to price breaking under this horizontal range to continue the larger downtrend. As usual, there's a tendency for more significant opposition to the trend nearing those final arcs. Now, with the firm halt to the drop in price, a stable uptrend has begun to take hold. One of the first choices would be to base a fib arc on the first upswing point. Since it's a smaller fib arc, it's good to see that preferred characteristic of the reversal candles being mostly contained within the first arc. And although it's a volatile period with large candles, short-term price action still follows the curvature of the arcs to an extent. showing short-term resistance and support during the rapid formation of sharp swing points within the neutral to increasingly bullish range. In addition, we see continuation characteristics at some contact points with the arcs, specifically flatter price action and/or large breakouts. While it's possible to base arcs on these continuation points, using these kinds of steep segments within the middle of a trend tend to be less reliable, with the result often being price not following the curvature of most arcs, though it's still normal to see them capture some retracements and even moderate reversals. More common choices will be what we've already covered, where the points are placed at the start and end of a full trend or around swing points that relate to the trend's starting reversal point, resulting in the arcs capturing more retracements that follow their curvature, and in this case, large red candles form to carry the downtrend further, often very close to the arcs, especially the outer ones. Trying to draw an actual trend line with the 2 points of the arc produces mixed results, such as in this example where downtrend lines are drawn from downswing points, though it can sometimes be a viable option in addition to using the first swing points near a reversal area. Combining a fib retracement, especially with 2 arcs, can lead to a messy chart. Combining a single fib retracement with a single fib arc is the better way to go in most cases. The arcs enhance the retracement by giving us a better idea of the arc they will follow, such as with the upswings and uptrend here. In terms of intersections with the retracement levels with the fib arcs, significant events can take place on the chart near these intersections of the two tools. However, results can be mixed, and it's not the most reliable or consistent method. One of the best options to choose first is to actually base both the fib arcs and retracement on the same 2 swing points, rather than cases like this where they're based on different points from different trends or different segments within a trend. While this combination is far from perfect, it can still often produce decent results, especially with a moderately sized clear trend such as this one. Particularly near the middle here, there's good detail on the potential path those retracements could take. And it's also good to see their preferred characteristic of most of the reversal candle being contained within the first arc. In theory, placing a fib time zone on the chart, then placing the first point of a fib arc at the same point that begins the fib time zone at a reversal point, then extending the second point of the fib arc to the 5th line of the fib time zone horizontally, in other words, straight to the right side, can project some fib arcs for an element of time analysis during the early stages of a trend developing. Ideally, this should provide fib arcs that are proportional to the fib time zone, so that the 8 and 13 fib time zone lines line up close to the beginning of these arcs. And it's great if the line at 21 and beyond also line up close to the fib arcs, but this will usually not be the case, and the main focus is on 13, and especially 8. In this example, the fib arcs are not close enough to the fib time zone lines, meaning the intervals are too wide and it produces poor results. Objectively too wide is when the fib arc and fib time zone lines at 8 and 13 are more than 1 unit of time apart. So in this case, since it's a daily chart, the fib arc and fib time zone lines are 2 days apart. That would be 2 units of time. So that's too far apart, only 1 unit of time, or 1 day is acceptable in this case. It simply means the fib arc will be proportionally too large compared to the fib time zone. If you want to learn more about the fib time zone and other fib time tools, there are already lessons about that, so you can better understand why certain intervals are chosen in these examples. But in short, we want a shorter interval in this example, so the arcs will be proportionally closer to the fib time zone lines, in such a way that there will be 1 unit of time or less between the fib arc and the fib time zone lines. That is indeed the case here. Using the time measuring tool, we are 1 bar apart for these intervals. Since it's a stock chart, there can be more than 1 day displayed even though it's still 1 bar or 1 unit of time, especially when it's like in this case, a few days when there is a break and the market is closed, such as with a weekend or holidays. The idea is that the resulting fib arcs, especially those close to the fib time zone lines, will approximate the path of some moderately sized retracements and even trends, along with continuation and reversal ranges, such as the double top formation near the end of this fib arc. This combination of proportions with these fib tools can be an additional choice to areas of significance in price and time that have been identified by other methods. On a chart like this with a persisting downtrend, another downward acceleration is quite likely. Particularly with a well-defined slope recently, that does lead to a descending triangle continuation. Now with this defined break under the 2860 level, attention now focuses on the last trendline segment for the placement of the fib arc tool that has the full circles option checked. To better understand this, please watch the other series on fib circles because yes, we're still using the fib arc tool here, but it incorporates ideas from the Fib Circles tool. The short, clear, and recent trendline segment next to the breakout of this bearish continuation provides good conditions to use this method with Fib arcs on the full circles setting. These recent structures of the continuation also give good, clear references for placing a trend-based Fib time zone. The trendline segment we're referencing also has a good angle. It's not too shallow or too steep. So naturally, when falling price contacts an area where there are intersections with these two Fib tools, there's greater opposition to lower prices even though it's an overwhelming downtrend. Unsurprisingly, this has resulted in a major delay to the steep drop, with a tendency towards more neutral to even bullish movement. And there's the normal tendency of this movement to follow the curvature of these arcs to some extent. Of course, it doesn't guarantee a major reversal back to the mid-28 area, especially with the recent return of stronger selling and the bearish continuation earlier, along with the broader bearish context we highlighted at the beginning of this example. So this is a realistic result where we do highlight the approximate area where a bullish retracement takes place to significantly slow the downtrend. It would be unrealistic to always expect to find the exact area of a major bullish reversal. And here at the very edge of the circle, intersecting with the one interval line, is a decent approximation of the end to the bullish retracement. Then when there is a significant bullish reversal, it's possible to apply a similar method, but it doesn't work out so well since the trendline segments are either too steep or shallow, and the swing points available to reference are relatively far apart, though they are quite recent and clear. The main feature of interest here is the convergence of the Shande momentum oscillator and the choppiness index indicators towards each other for a relatively short time, followed by their divergence back away from each other. For an uptrend, like in this example, falling values for the Shande momentum oscillator and rising values for the choppiness index help identify when price could begin to slow down towards consolidation and even a possible bearish reversal. Also important is just a basic trend line to which we can also add a Fib retracement, especially after price has closed under it. A Fib fan could work here in terms of finding trend lines at lower ranges following the further drop. However, if the consolidation range begins to flatten, Fib arcs might work better as price continues in a neutral to bearish range after retracing just two Fib retracement levels. Fib arcs provide good detail on these prolonged consolidation ranges. Whenever price falls onto those intersections between the Fib retracement levels with the Fib arcs, upswings are much more likely. And since this is sustained for longer, market sentiment goes from bearish to neutral, then towards neutral to bullish. And of course, now that there's this large green spike going over the previous highs, attention will focus on consolidating over 28 and up into the 30s. This consolidation range is much shorter and narrower compared to the less common scenario of what we just looked at with the Fib arcs and retracement. Now going back to the breakout point and focusing on the indicators, we can see the convergence and divergence we discussed earlier, demonstrating how even an initially strong break can quickly fall into consolidation prior to the possibility of a trend continuation, reminding us why it's important to also pay attention to short-term development, while also marking a key price range based on important opening and closing prices, along with other structures on the chart, such as previous highs and gap levels. Then the criteria is quite simple. Price must remain firmly over this range that defines a lower boundary for the consolidation area in order to improve the chances of a bullish continuation forming. Similar to other Fib tools, two arcs facing the same direction could be combined. However, in practice, areas where there are two arcs close together don't necessarily hold more significance than areas where price just contacts a single Fib arc. This is especially true when arcs are spread further apart and price nears the end of the Fib arcs. Another option to combine Fib arcs in the same direction is to position them in a similar way to a trend-based Fib time zone. But regardless of how the Fib arcs are combined in the same direction, it's not very useful to have them too close together like this. Instead, it's better to have one Fib arc comparatively much larger than the other. That means there's more space between the two arcs and less clutter on the chart, resulting in it being much easier to see instances where movement approximates the curvature of the arcs. This example begins with the gradual end of a major uptrend, which provides clear landmarks to reference for the placement of a fairly large Fib retracement. And with a stable start to a downtrend, we can even use the first two downswing points for the basis of these Fib arcs that have the full circles option checked. As would be expected when price falls onto the intersections of these two Fib tools, there's naturally at least some support against the drop. And resulting retracements can approximate the curvature of these arcs. When price rises towards these intersections, they can also be areas of interest more likely to produce downswings. The result will of course be some drops on the chart, but they naturally won't follow the curvature of the arcs, which can only see price move up and to the right, rather than down and to the left. With the downtrend firmly established, attention is now focused on the next intersection, which does provide support against the drop upon contact. But under real-world conditions like this, it's not always guaranteed to result in a reversal or even a minor retracement. Likewise, it's possible for an upswing to take place at an area where there's no intersection between the two fib tools. These intersections merely mark areas of greater interest, where movement is more likely to be opposed. And since the chart is now on a climb towards the next intersection, it's fairly normal to see neutral to increasingly bearish movement nearing that approximate area. To be more relevant, the downtrend line can be extended towards more recent downswing points, still resulting in intersections taking place at the same approximate areas. The same can be said for shortening the downtrend line to more recent swing points, especially positioned on these two downswing points where the downtrend began to accelerate. We'll use the same method as the last example, except this will be with a much steeper and a less stable trend. So yes, there'll still be some minor upward movement when falling towards the curvature of the arcs. However, it's not surprising that there's no long-lasting support and there are only minor to moderate upswings. In the broader context, this stands out as one of the more significant areas. We can still identify the approximate start of this large consolidation area, perhaps even better when trying these standard variations where we extend the downtrend line further to more recent downswing points, as well as moving to a shorter downtrend line segment positioned on more recent downswing points. To further improve on this, we can build on the element of time by adding a trend-based Fibonacci time zone, positioned first at the shortest duration possible in the context of this downtrend continuation, then the longest duration possible right up to when the continuation begins. The vertical lines closest to our area of interest helped narrow down the time range when contact with the arcs was more likely to produce something significant. Not necessarily a complete or even moderate reversal of the downtrend, but rather major opposition to the established drop, which in this case is the beginning of the long-standing consolidation range holding the chart relatively flat. For more on Fibonacci methods as well as indicators, follow Ascencore. Thanks for watching and have a nice day.